Hi, this is Robert Biggs from myoptionsnet.com. I want to thank you for coming out to visit us and sitting in on our free webinar. This is for guests that have clicked on ad from Facebook. And here's a little tour of our VIP area for our members at myoptionsnet.com. And these are some of the things that our members receive. We have webinar replays for webinars, well, such as this, and our regular training webinars and things that we're going over. We have a complete video training library that is message specific. And then we have an article library, and these libraries are continuing to grow and grow and grow. And these are designed to help you as a member of myoptionsnet.com to understand more of what we're doing and why we're doing it. The goal is for us to help you make money. If you're trading and you're not considering this as a business, and this is just a hobby, or this is just a pastime, something like that, then you might want to just go to the sidelines, work with a simulated trader, and not actually put money at risk. If you're going to be trading with real money, you want to really know how to do this, and that's what myoptionsnet.com is here to provide. We're here to provide you with the knowledge and the wisdom and the skills to trade effectively, and that's going to give you the confidence to actually place the trades and to overcome the mental obstacles that hold back traders. And the two negative emotions that we're going to be dealing with are going to be fear and greed. And fear can be overcome, and greed can be overcome by just a couple simple exercises that we'll be going over. Now, we use OptionView to help us analyze some of the trades that we want to look at. Right now we're going to look at Apple here, and let's see, here we go. Okay, this is these are option chains. This is for the March 22nd option for Apple. Up here, these are the calls, and down here, these are the puts. And we can scroll up and down as we want to. If you were fortunate enough to watch our video from last week, you'd see a option trade that we did with Apple that was where we sold the 545 calls, and we bought the 560 calls, and it was a ratio spread. We sold 10 of the 545s and bought 20 of the 560s. Now that trade is already done. There was about $455 that was made on that trade in about 3 days, and so that was a nice little trade for us. These options have, as you can see, it has about 22 days till expiration, and it expires on March 22nd. So what we're looking for is, we'll give you an example. Okay, we're looking at the 530, so let's look at the 535 call. Okay, if we sold, let's sell 10 of those, and we'll buy, that was 535, so let's look at the 530.50. We'll buy 20 of those, and you'll see that we'll have down here, we'll have a credit of $1,405. Now it does have 22 days till expiration. This required, the initial margin requirements were is 13,745. This is figured on using the Black-Scholes formula for margin, which Black-Scholes is a formula that was designed as a risk management program and started in the Chicago exchanges and is now spread in virtually every exchange across the world uses the Black-Scholes formula for risk management. So anyways, that's what between the 13,745 and the $1,305. Now you're going to see this change is going to be dynamic because these options are going to be always changing. Now if we actually had initiated this position right now, we'd have $1,305 to be added to our accounts, and that would be after commissions and all this stuff. So anyways, this is what's called a ratio spread. And so now let's see when we're going to make money on this particular trade. Okay, we could go through the valley of death here, and we could have times where we'd not be making as much money. But if the market continues, if the market were to continue on down, once it gets down to around 530, well, right now from 535 on down, we're going to pick up between 900, well, right here, 110 bucks, 400 bucks, 630 bucks, and as it goes down further, and as time goes by, those options become more worthless because of time decay. And we pick up more and more money as the market continues on down. Now, if it starts going up, remember we've got 20 call options that we bought up here at 550, and we've only sold 10 options, 10 calls at 535. So there is a small period here where we could actually lose money on the trade, and then as it comes back up, we have unlimited profit potential. So we have limited profit potential on the downside, we have unlimited profit potential on the upside. So if this market gets up to around 565 or so, 560 to 565, right in here, that's where our break even would be. And by that point, we're making considerable money. This, based on this particular model, this would show that where the market is actually breaking over here. That would be on just a 10 and 10 spread, but because we've got a 10-20 spread, we'd actually be picking up around $7,560. And then if the market got to 571.50, we'd have about 11,000 in profit, then 16K, 21K, 26K. So it just goes up and up and up and up. So if Apple goes up to 575, 580, 590, this is going to be an enormous winner, and we're getting paid to put this trade on. So the only time we have any risk at all is right in here, where we potentially could lose some money. But because it's such a strong credit, we have a tremendous opportunity to make great money. So as we're looking at this, we may want to look at, well, let me go back here to the analyze. Well, let me look at the, let's look at the volatility chart. Okay, we're just waiting for data here. Okay, now what this shows us is that this is the statistical volatility, and that is where what this indicates right here, this number right here, the statistical volatility, which is represented by the red line down here, that is where the volatility has been about 18% of the time. The implied volatility, which is what we really want to pay attention to, the implied volatility actually right now is below the statistical volatility, and that implied volatility is about where it's been 1% of the time over the lifetime of this particular chart. So the implied volatility is actually quite low compared to where it normally is. And now, if we were doing something like a strangle, we'd want to make sure that this implied volatility is significantly higher. This blue line right here, we're significantly higher than the red line, and the red line, the statistical volatility, was in an area where it normally is at. So we'd want this number to be significantly higher, and we want this number to be even higher than the statistical volatility, which will be represented by the red line here for the statistical, and the blue line here for the implied volatility. Now, the reason why volatility is so important is statistical volatility is an indication of where the actual underlying asset, whatever that happens to be, in this particular case it's Apple, this statistical volatility is where the actual underlying asset has really been trading at. The implied volatility is the perception or the consensus of where the market might be going. Let me give you an example here. Okay, let me go back to a different asset here. Let's see here. Okay. Let's see if we've got this here. Okay. All right, market is currently at 1862. Okay, let's go. So let's go 30 points up, 35 points up. Let's go to 1895. Okay, at 1895, we see that option, or 30 points away from the market, we see that option is worth, that call is worth 610. You see this? That's the 1895 call. Remember, these are the calls up here. These are the puts down here. The 1895 call is at 610. Okay. Now let's go from 1865 to 1835 on the put side. And let's see. The put, again, we're only 30 points away, but the put is worth 11. So it's almost twice what the call is at, equidistance. In other words, 30 points on either side from where the market is. So what does that tell us? That tells us historically a call and a put equidistance from the from where the market is right now, which in this particular case is 1862.50. When you see a disparity like this, that would be an indication that there's a greater sentiment that the market's going to be going down rather than going up. So that is just a little tip of the hand. This is one of the ways that options helps with all types of trading, whatever you're trading, whether you're trading mutual funds, stocks, or whatever it happens to be, whatever the underlying asset is, options oftentimes can tip the hand. So in the not too distant future, I would expect to see somewhat of a pullback in this particular market. And so let's see what this is telling us. Okay, let's look at the volatility chart on this. Okay, again, the volatility is really quite low, but it does show us that the statistical volatility is where it has been about 25% of the time. You can see the red line in here, and so about 25% of the time, this is about where the statistical volatility is. And the blue line indicates the implied volatility, and we're seeing that the implied volatility is where it has been about 24% of the time. Now, one of the reasons why it's been very difficult for people who are just writing straight options, just writing straight strangles, to make much money in the last few years is because the volatility, the statistical volatility, has been about the same and oftentimes slightly higher than the implied volatility. What we want is we want the implied volatility, as we see right here, we want the implied volatility to be higher than the statistical, and the statistical to be in a normal trading range. So we'd want it back up around here someplace. And so right now we're just not seeing that. So these are all the things that you're going to be learning with myoptionsnet.com, and we look forward to work with you and helping you and answer any questions that you have. We have a number to go back to myoptionsnet.com. We have a number of people that we've joined forces with that have been in the business for years and years and years. We partnered with OptionView, and the fellow who started OptionView, Len Yates. Here's a video of his. It's from December of 2013, and we have some other videos also from other people that are experts in the options and trading business. Steve Lentz, he's the head of education for OptionView. Steve Papali, Frank Fahey, and a number of different experts, and we're adding to that list all the time. And then we've also got let's see, let me back up just a little bit here, and we've got the article library. We've got articles that are for beginners, for intermediate traders, and for advanced traders. And so you can see in here, this is just a quick view of the library. You know, basically what is an option, bringing fundamental analysis into your trading, buying deep in the money puts, or options rather, choosing the best option strategy, and that type of thing. And then those are the things that we're going to be working with you on. And so all this stuff is going to be available to you, and we're going to actually teach you all we can about trading options. You're also going to be able to participate in our regular weekly interactive webinars, and we're setting up a real-time trading room, so you'll be able to come in here. We'll be able to place real-time trades with you, and right from these portfolios or these platforms that we're going to be showing you, you'll be able to trade directly. We'll also be able to coach you on and we get nothing for it, but we can coach you on some of the better stock brokerage firms that you're going to want to work with, that will provide you stock and options trading abilities, where you can both buy and sell stock options. Now, if you're dealing with a broker who won't let you do those things, or is not familiar with options trading, then you may want to consider looking for an additional broker that actually is extremely familiar with options trading, and we have a few that we can refer you to. But you want to make sure that you're dealing with someone who has a tremendous amount of experience and knowledge in options trading, where when you call up your order, you can just tell them what you want to do, and they can help you structure the trade properly. So let's see here, 1 second. I'm going to get a drink of my vitamin water. We're going to have regular webinars every week. We're having webinars for our members, and we're going to be having guest speakers. We're going to have some of the experts from OptionView. We're going to have some experts from a variety of different places. Some of the folks you've probably actually seen on TV on some of the channels like MSNBC and so on, maybe Fox Business. We're going to have them as guest speakers to actually help you understand options better and better and better. And we're going to be going into detail about volatility, technical analysis, choosing the strategy that best fits the trend of the market, whether the trend is going up, trend is going down, or trend is going sideways. There are strategies to benefit from every market situation. So we're going to be going over all that stuff, and we're excited about getting back in the saddle here. We've been semi-retired for a couple years after running a retail brokerage firm for almost 20 years, and we're looking forward to working with you and helping you understand what we do in the markets. We manage money for banks and insurance companies and extremely high net worth individuals for a number of years. We stopped that in 2005 and kind of semi-retired, but you know, you can only throw a tennis ball with a dog so long, and then you have to get back to it. So I'm only 57 years old, so I had to get back into things, and so here I am, and you're going to be introduced to Len Yates, Jim Graham, Steve Lenz, as well as the other gentleman I mentioned to you, James Hogan, and a number of different gentlemen from OptionView, as well as from a number of other places as well. And you're going to be excited when you see these people on your screen. They are going to just actually knock your socks off. So, anyways, we look forward to hearing from you, and we want to thank you for coming to today's webinar. It's a big invite, and we look forward to working with you. Thanks.